Alright, if you follow markets even casually, you need to hear this. Because something important is happening right now and most people are completely misreading it. I'm seeing the same headlines you are. Gold and silver getting absolutely hammered. Volatility everywhere. Confidence shaken. And the instinct, the natural reaction, is to assume smart money's running for the exits. But here's the real story. While paper markets are swinging violently, China's quietly doing the opposite. And they just confirmed it again. Stay with me, because I'm going to show you how to spot this pattern yourself before it shows up in the price. And if you're watching this right now, you're already ahead of 90% of people who only read the headlines and never look underneath. Now, before I explain what caused this latest move, let me teach you something most people never get told about financial markets. Markets don't move as one unified thing. They're layered. There's the fast, emotional layer. That's the futures traders, the algorithms, the leverage, the people making split-second decisions based on fear and momentum. And then there's the slow, deliberate layer, where physical assets actually change hands. Think of it like this. It's the difference between headlines flying across your screen and the actual money moving behind closed doors. The headlines move fast. They're loud. They grab attention. The money moves slow. It's quiet. It's intentional. And when those two layers diverge, when they start moving in opposite directions, that's where opportunity and risk starts to build. That's the pattern you need to train your eye to see. Here's what you need to know about gold and silver specifically. These aren't just trades. They're not stocks. They're not crypto. They're monetary assets. When central banks buy gold, they're not trying to catch a bounce or scalp a rally or make a quick profit. They're making a statement about trust, about stability, about long-term risk. So when you see official data showing that the People's Bank of China added gold to its reserves for 14 straight months through December 2025, that's not noise. That's policy. That's intent. That's a decision made at the highest levels of financial strategy. If this is making sense so far, drop a comment and let me know where you're watching from, because I want to know who's paying attention. Now here's what's actually happening beneath the surface. Let me break down the sequence because this matters. First, global markets sell off hard. We're talking broad risk-off sentiment. Leverage unwinds, margin calls hit, and paper gold and silver get dumped because they're liquid and they're easy to sell when you need cash fast. That's the primary driver of the crash you just watched. That's what creates those violent downward candles that make your stomach drop. It's not fundamentals changing overnight, it's mechanics. It's forced selling. Second, while that's happening, while Western futures markets are in free fall, physical demand inside China doesn't disappear. In silver, it actually stays elevated. You've got retail buyers who see lower prices and step in. You've got industrial demand that doesn't just vanish because a futures contract got sold. And then the third piece hits. China introduces new silver export controls starting January 1st, 2026. So supply tightens locally, even as Western paper prices are falling. You see what's happening here? The futures market's saying one thing. The physical market's saying something completely different. Here's what's wild about that. Local silver prices in China stay firm. They don't follow the futures market down. That divergence is your signal. That's the market telling you something doesn't line up. When futures-driven selling pushes prices down, but physical buyers step in and say, "No, we'll take it here," that's a structural imbalance forming. And here's the part that should make you nervous if you're ignoring it. Those imbalances don't resolve sideways. Historically, they resolve violently. They snap back, because you can't have paper prices disconnected from physical reality forever. Eventually, one of them has to give. Now let me show you what very few people are talking about. While silver's getting crushed in the futures market, the Shanghai Gold Exchange is showing premium pricing for physical delivery. That means buyers in China are paying more than the global spot price to get actual metal in hand. That doesn't happen in a normal market. That happens when there's a shortage Or when people don't trust, they'll be able to get it later. And when you layer that on top of official reserve accumulation and export controls, you've got three independent signals all pointing the same direction. Physical is tight. Paper is loose. That gap is real. Now let me zoom out, because this isn't new. This is the exact same playbook we've seen before. In the early 2000s, central banks quietly accumulated gold while prices stayed depressed. The market consensus was that gold was a barbarous relic, that nobody needed it anymore. And then the market re-rated higher. Gold went from under $300 to over $1,900 over the next decade. Same pattern. Quiet accumulation while everyone else was looking the other way. After the 2008 financial crisis, paper selling dominated headlines. You had massive deleveraging, forced liquidations, everything getting sold at once. But physical premiums told a very different story. Coin dealers couldn't keep inventory. Mints were running at capacity, and gold doubled over the next few years. The people who panicked during the crash missed the entire move. Even in 2020, when everything was chaos, when COVID hit and markets were collapsing, physical shortages showed up before prices exploded higher. You remember that? You couldn't get silver coins. Premiums were $15, $20 over spot. And then silver went from $12 to nearly $30 in less than a year. When you look at the pattern, it's always the same. Paper breaks first. Physical tells the truth later. The disconnect creates the tension, and then price catches up to reality. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this be wrong? Absolutely. China could pause purchases. They've done it before. They'll probably do it again. Demand could cool. Industrial use could slow down if the global economy weakens. And futures markets could stay irrational longer than anyone expects. That's always possible. And here's the thing about manipulation narratives. I see people complaining about manipulation constantly. And maybe they're right. Maybe they're wrong. But complaining about it doesn't help you. What helps you is focusing on what you can actually observe. Official reserve data. You can verify that. Physical premiums. You can track those. Export restrictions. Those are published policies. Those are real-world signals, not opinions. So whether you think markets are manipulated or not, the mechanics still matter. The data still tells you something. There are probably three types of people watching this right now. Some of you are long-term holders. You already own gold or silver. Maybe you've been stacking for years, and you're watching this price action, and you're wondering if you should be worried. Let me be honest with you. You should expect volatility. This isn't over. You're going to see more of this. But nothing you're seeing here invalidates the long-term thesis. Central banks are still buying. Physical demand is still there. The fundamentals that made you buy in the first place, they haven't disappeared. If you're holding for the right reasons, this is noise. Some of you are traders. You're thinking about timing, entries, exits. You're looking at charts right now, trying to figure out where the bottom is. For you, the lesson is patience. When physical and paper diverge, price eventually follows structure, not emotion. But it doesn't happen overnight. You might have to wait. You might have to sit through more pain. And if you're trading with leverage, you need to be really careful here, because these moves can wipe you out, even if you're ultimately right about direction. And then there are some of you who are new. You're just trying to make sense of the noise. You're hearing conflicting narratives, and you don't know who to trust. Your takeaway is simple. Don't let short-term price action convince you that fundamentals disappeared overnight. They didn't. Markets are emotional in the short term. They're rational in the long term. Learn to separate the two. Ask yourself, what's mechanical selling and what's actual demand destruction? Because those are very different things. So, here's what I want you to answer in the comments. Which of those three are you? Are you a long-term holder riding this out? Are you a trader looking for entry points? Or are you new and trying to learn? Let me know, because I'm genuinely curious who's watching and what you're thinking. Here's where I stand. I'm not panicking, and I'm not blindly bullish either. I'm watching signals. Let me tell you what I'm personally watching. First, I'm watching China's official gold reserve updates. They report monthly, usually around the 7th of the month. If they pause, that would tell me something about their near-term outlook or maybe about political messaging. If they keep buying, that confirms intent. Second, I'm watching physical silver premiums, especially inside Asia and on exchanges like the Shanghai Gold Exchange. If those premiums widen further, that tells me physical is getting even tighter. If they collapse, that changes the story. Third, I'm monitoring whether export controls tighten further or quietly expand. China doesn't do things randomly. If they expand controls to other metals or tighten enforcement, that's a signal about strategic priorities. Based on my analysis, this crash was mechanical, not fundamental. The fundamental picture hasn't changed. You've still got central banks diversifying away from dollars. You've still got industrial demand for silver that's structural, not cyclical. You've still got supply constraints that aren't going away. None of that broke. What broke was leverage positioning in a risk-off environment. And when leverage unwinds, it doesn't care about fundamentals. It just cares about liquidity. If history rhymes and physical demand keeps absorbing supply while paper markets stay volatile, the move that follows could be significant. I'm not making price predictions. I don't know where gold's going next week or next month. But I know that structural imbalances don't stay unresolved forever. And I know that the people who understand the difference between paper and physical, who watch the right signals instead of just reacting to headlines, those are the people who position themselves well. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. But if you made it this far, you're someone who thinks critically, who wants to understand how things actually work instead of just following the crowd. That mentality will serve you well, not just in this market, but in every market you'll ever participate in. If you found value in this, share it with someone who needs to hear it. Subscribe if you want more breakdowns like this. And stay ahead of the noise, because that's where the real edge is. Think critically.